Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a tutorial on impairment of assets. This is more sort of related to the GAAP or the accounting standards or maybe the US GAAP and so on and so forth. So let's get into the nitty-gritty of the same. It's written over here, 9 years since the Tata Steel Limited made its most expensive acquisition, purchasing Anglo-Dutch steelmaker Chorus. It has taken an impairment charge of almost $3 billion and analysts expects more to come. So what exactly they are trying to say? See, impairment isn't basically an accounting principle, and that has been used to reduce the value of the company's assets. So the asset of the company are basically, they have been tested for impairment annually. Very important, they are tested annually, and if impaired, an impairment loss has been recognized in that particular regards in the income statement, and the balance sheet is basically adjusted accordingly. So cash flow statement is not at all affected by the impairment, as there is no cash transaction taking place at the time of the impairment. See, we note that from this particular snapshot that we see over here, in this particular snapshot, Tata Steel, with the most expensive acquisition of Chorus Group, has taken approximately $3 billion of impairment charge until now, and impairment charges have negative impact on the financial statement as well. So in this tutorial we are going to look into various things, mainly the fixed assets basically which are been tested for impairment. There are basically two types of fixed assets. The one, I'll write over here, the fixed assets, they are of two types. The one is called the tangible one, that is known as your tangible assets, and the another one is called intangible assets. Intangible assets. One is called tangible and another is called intangible assets. So before understanding how a specific asset is impaired, we need to understand how it has been reported on the balance sheet. So the first and the foremost thing that we are going to look about is how are the tangible assets, they are being basically reported in US GAAP and in IFRS. See, different standard used by different countries all around the world have different methods of reporting. See, if you talk about US GAAP, then in that particular case, they use the cost model to report the tangible assets, and you can say the tangible assets, mainly the property, plant and equipment. The land is reported on the amortized cost, historical cost, that is minus accumulated depreciation on amortization, depletion, impairment of losses. So here the historical cost refers to the purchase price. You need to add anything that is in this, any sort of the cost that are related to the same to make the asset on ready for use, and over the period of time the value of the asset reduces as we charge depreciation as expense every year in the income statement, which then reduces the value of the asset in the balance sheet. See, if we talk about things in terms of IFRS, then in that scenario most assets are reported at the depreciated cost model, so that is known as the cost model. Now in this particular case, what exactly happens is that IFRS provides basically an alternative, the revaluation model, in which an asset can be reported at its fair value till the time an active market is there for the asset. An active market is necessary because the asset's fair value can be reliably estimated only if it has been actively traded. So the use of the revaluation model is not very frequent at IFRS reporting, but you can say, it's still good in a way. Let's see how things work out in case of the impairment of assets in both the scenario, that is impairment of assets in case of US GAAP and in case of IFRS. US GAAP is basically the norms that US follows, and IFRS is International Financial Reporting Standards, which the international standards have been adopted. So under US GAAP, the test for the impairment of fixed asset is done only when the events and circumstances indicate that, over here there is sort of a recovery of carrying value might not be possible through future use. So determining the impairment of calculating the loss potentially involves basically, it's a two-step process. In the first and the foremost step, what has been done is that the asset is tested for impairment by applying the recoverability test, and if the asset is impaired, the second step that involves is measuring the losses. So that's the second step. See, recoverability test, if you see over here, in this case if the carrying value, that is the original cost less the accumulated depreciation, I'll have to write things for you. If in this scenario, your carrying value, which is your original cost less any accumulated depreciation, if that is greater than the asset's future cash flow stream, then the asset is considered as impaired. So as the recoverability test is based on the estimates of the future undiscounted cash flows, test for impairment involve considerable management discretion. Now the loss measurement. If the useful value of the asset is written down to its fair value over here, okay, and on the balance sheets, moreover, a loss is recognized in the income statement. This loss is taken to be equal to the excess of carrying value over the fair value of the assets. Now, let's see the impairment of the fixed assets under IFRS scenario. What exactly goes on around here? In case of IFRS, under IFRS, the firm needs to assess annually whether the event or the circumstances indicate an impairment of the asset's value has occurred. For example, there may be a considerable decline in the value of the asset or a major change in the asset's physical condition. If so, the asset value must be tested for impairment. See, when carrying out year of an asset, if the carrying value over here, if that exceeds the recoverable amount, then in that scenario, what exactly happens is that the asset can be impaired. Over here, this thing can be impaired. Now, what happens, the recoverable amount over here is equal to the, if that is the recoverable amount, if that is basically equal to your fair value minus any selling cost or its value in use, then in that scenario, whichever is greater, then the process of computation of the value in use involves basically following formula. So value in use will be equal to the estimation of the future cash flow, okay, would be generated by the asset, and the calculation of the present value of the future cash flow by applying the appropriate discount rate, that is basically your WACC. Once you apply that, you get your amount, and whichever is higher will be the case. So reasonable assumptions must be taken in order to project the future cash flows. The item that should be avoided while projecting the future cash flows include like exaggerated revenue growths, significant anticipated cost reductions, and unreasonable useful life for plant assets. So avoiding these items will result in more meaningful results. Similarly, any extraordinary growth of the recent times should be assumed to last only for near-term future, and should not be projected to continue in the long term. So if impaired, you can say that in the assets value must be written down to on the balance sheet to the recoverable amount. So n impairment loss equals to the excess of the carrying value over the recoverable amount is recognized in the income statement. It is only under the IFRS case what happens that the company is allowed to reverse its losses. Value of the impaired asset recovers in its future. So however, the loss reversal is limited to the original impairment loss. Hence, the carrying value of the asset after reversal cannot exceed the carrying value before impairment loss that was recognized. In US GAAP, loss recoveries are not at all permitted, unlike what happens in IFRS, where the company can recover its losses but cannot exceed the original carrying value of the stated amount. Now, how our intangible assets are recorded under US GAAP and IFRS? I'll just write intangible for US GAAP and IFRS. See, intangible assets are of two types. One is called, the identifiable, another is called unidentifiable. So identifiable are those type of assets which have finite life, and therefore these assets are amortized over a period of time, and the expenses are recorded in the income statement. If I give some example of the identifiable assets, that includes trademark, copyrights, etc. So there is another called unidentifiable, and those are have an indefinite life and cannot be amortized at all. So this are tested for the impairment just like what we did for tangible assets, right? So over here, it's the same thing has to be done. Under US GAAP, the goodwill can be tested once in a while. So I'll just write for you goodwill, and it can be tested once in a while. Now, in case of other things, goodwill must be tested for impairment. In IFRS case, it should be annually. Okay. So reporting of the unidentifiable intangible assets is done similar to the tangible assets, that is under US GAAP and under IFRS situation. Now let's understand the impairment of the intangible assets under US GAAP and IFRS. See, goodwill which has basically been created in a purchase acquisition can be tested for impairment. So goodwill created internally should be expensed as incurred. Impairment of goodwill is basically similar to the tangible assets under US GAAP and IFRS both. So, I'll show you that, Toshiba Corp had to record close enough to 2.3 billion and goodwill impairment charge on the value of the Westinghouse cranberry based nuclear firm. Let me show you that. This article specifies the same, Japanese parent company has demoted the value of cranberry based nuclear firm 10 years after buying the business of 5.4 billion around. And it will record a 2.3 billion impairment charge on the goodwill value of Westinghouse. So, let's understand some examples on impairment. See, let's say basically on April 1, 2005, there was a company called Belforing. They bought a building for around close enough to 2 billion. They bought around for 2 billion and sorry, not 2 billion, for 2 million. And the estimated life of the building at the time of the purchase was close enough to 20 years. Depreciated method was used as the straight line SLM method was been used. On March 31, 2009, the company came to know that about a flyover construction which would be adjacent to the building, which would reduce the access to the building, decreasing its value. So for 1 million, the company estimated to sell the building, but would have to incur some cost of close enough to 50,000. Another option which the company had to consider that to use, which would help the company generate a present value of around $1.2 million. Okay, so now if the carrying value over here exceeds the recoverable amount, we will have to impair the building by the difference between the carrying value and the recoverable amount. Now, if you see the carrying amount, the building was originally bought for how much? The building was originally bought for 2 million with its estimated life of 20 years, which is used for around 5 years, which is used for 5 years so far. So this gives us an accumulated balance as is equal to 2 divided by 20 into 5, which gives us 0.5 million. So to calculate the carrying amount of the building, we need its formula, which is carrying value is equal to the amount at which the asset was purchased minus any accumulated depreciation. Therefore, the 2 million was the amount, right? And less 0.5, that will be 1.5. Now the recoverable amount over here is higher of the fair value minus cost to sell or the value in use as we discussed about. So therefore, in case of 1 million minus 0.05, that gives us 0.95. So the value in use is basically equal to the present value of the future cash flows, which in the question was given to us that that was 1.2 million. So as discussed in this particular case, the recoverable amount should be 0.95 and 1.2 million. So the carrying amount is 1.5 million, which is recoverable amount, and is 1.2 million. So the company will have to book an impairment loss of 0.3 million. Okay, so 0.3 million is the amount of the loss they need to book. But there are this list of the companies with the highest level of impairment charges, like Devon Energy, with having a huge market cap. It has a high level of asset impairment of close enough to $20.820 million. That's really big. Bank, Bradesco, HSBC Holding, Merck, 3948. You can see Halliburton, and so on and so forth. Now let's understand the impact of the impairment on the financial statement. See, if the impairment loss is recognized in the income statement in the same section where we report our operating income and expenses, with this loss, the profitability for the year is affected negatively. So I'll show you an income statement of Schlumberger Limited. It reported a significant impairment charge of close enough to $3172 million in its income statement, resulting in net loss of $1687 million. 3172 is the impairment charge that they have recorded. See, at the balance sheet level, if impaired, the asset is written down to the amount equal to the impairment loss, which is recognized in the income statement. In the cash flow statement, there is no impact on the cash flow statement as there is no transaction that has taken place. So I'll show you a snapshot of how the cash flow worked. We note that the cash flow from the operations is prepared using the indirect method, and wherein you start with the net income, add back all the non-cash items included in the income statement. Let me show you that. So over here, the impairment charge is there, which has been added back. Right. So finally, after all this, we can make a final conclusion that, at the very first, an impairment is basically an accounting principle that has been used to permanently reduce the asset. So under IFRS, an asset is tested for, you can say, for impairment annually, unlike under US GAAP, where there are 2 stages from which the company decides whether they have to impair the assets or not. So generally, fixed assets are tested for impairment. And fixed assets include both your tangible as well as your intangible assets. It includes both of the thing. And you can say that there are two types. I mean, intangible assets, identifiable and unidentifiable intangible assets. Identifiable assets are amortized over the life of the assets, and unidentifiable assets are tested for impairment. If you see for IFRS, the fixed assets are reported at depreciated cost, that is cost model. IFRS also provides a revaluation model, and in that particular case in which the assets is reported at the fair value, if the carrying value is greater than the recoverable amount, then the asset is said to be impaired, and the impairment loss, that is the difference between the carrying value and the recoverable amount, is recognized in the income statement. But if you see in case of the US GAAP, the fixed assets are reported at the depreciated cost, and the asset is tested for impairment in two stages, which we have learned. First, there is a recoverability test, which helps to determine if the asset is impaired or not. And second, there is a loss impairment. That is, if the asset is impaired, then what amount of loss do we have to report on the income statement? So an impairment loss can be recovered only under IFRS and not under US GAAP. Thank you, everyone.